Alrighty, I'm going to get started. Thanks everybody for being here with me today. My name is Jeff Bruskin. I am the founder and managing partner of White Tiger Connections. If this is your first webinar with us, I'll give just a brief overview of White Tiger and what we do. We specialize in all things connection-driven solutions in the accounting and the CPA profession. So connection-driven solutions, we do recruiting for CPA and accounting firms. We do mergers and acquisitions for CPA and accounting firms. We do management consulting for CPA and accounting firms. And we do partnership and affiliate creation for CPA and accounting firms. That's things like working with financial advisory firms, insurance brokers, real estate, what am I missing? Wealth managers, attorneys, anyone who receives clients, their predominant referral mechanism, or one of them, is the CPA and the accounting firm space. So we have in all of our the ecosystem of our offerings, we have a supply side and a demand side of our solution. It could be a candidate and a hiring manager in the accounting space, could be a buyer and a seller, could be a partner A and a partner B. And as long as it surrounds the ecosystem of considerations for a CPA or accounting firm, that's what we do. So that's our specialty. We've been around about 4.5 years now. We have 75 retained clients across the US. I'm in our Long Island headquarters here. We have a remote team, 17 people in the company today. Topic of today's webinar is financing strategies for accounting and CPA firm buyers. So if you're looking to buy an accounting firm or interested in kind of how that process works, that's what we're going to cover in today's webinar. It'll be 30 minutes, and I'm just going to try to talk for about 10 or 15 and then open it up to Q&A. So if you're in the meeting, you can ask any specific questions that you have. A few different options for how you can finance the purchase of an accounting firm. The first is cash. So that's obvious, right? So if you are, and I'm going to try to speak to kind of three different types of buyers, because if you're listening to this, you could really fall into any of the three categories. Category one is, let's say you are a disillusioned partner or senior manager or even a manager in a regional or a national accounting firm, and you are thinking about going off on your own, and perhaps you don't have any portable business, perhaps you have some portable business, and you're thinking about buying a practice as either a springboard to build your own firm, or maybe that's all you want to do is you just want to run a firm that's well packaged today. Very reasonable option. So that's the first profile. Second profile is you already run an accounting firm and you're thinking about buying another. So that's option two. Option three is maybe you don't run an accounting firm today, but you run a firm that's in an ancillary industry, such as a financial services, wealth management type firm, where you're managing assets of your clients. And you see the strong ancillary partnership opportunity that would come from purchasing a practice that has a book of tax clients, and you can not only do, let's say, tax strategy work with them, but also manage the assets and get involved with strategic vehicles for helping with tax savings and overall growing their wealth. And accounting services could be interesting to you too. Because maybe you're a certified exit planner. Maybe you're thinking about how, with the tremendous wealth transfer that's about to happen in the next 10 to 15 years, hundreds of trillions of dollars is being changed hands as all the boomers retire. A lot of those, the changing of the guard is going to happen through exits, where multi-generational family offices don't have a successor for the first time, and they're going to be selling the company. And if you own the accounting firm, if you run the CPA firm, it doesn't need to be CPA, it could be accounting, that is working with the multi-generational family office, and that person sells, the natural place for them to put their wealth is going to be with your asset management vehicles, right? So these are the three categories: individual, accounting firm, and ancillary firm, right? So the first option is cash. You might decide that you want to do a cash transaction. We strongly advise against this when we're advising buyers, because objectively in the accounting firm space, you don't need to have a cash rich deal. Typically, we see 10 to 33% of cash down is usually what is required to close on an accounting firm based on whatever the valuation of the transaction is. which is not a lot, right? It's extremely low relative to comparing to other industries. There are situations where we see 50, 60, 70% of cash in accounting, but that's very rare. 90% of the time, we're talking 20, 25, 30% of cash down is quite common, even less. But you can finance, that initial cash payment can come from if you have cash lying around under the mattress. If you're a firm owner in that second category, if you have operating capital that's left over in your business, maybe you have family and friends. So that's the first option, right? And as we talk about financing, this is actually a good point. Um, we want to talk about financing in the context of paying the down payment on the practice, right? It's a little bit of a separate conversation as you think about paying the full exit over a number of years. The cash payment is, the payment on closing is what's most important, because a lot of the time, and I know I'm jumping around a little bit here, but this is important. A lot of the time, if you pay 33% down on an accounting firm, the remaining 67%, let's say, can be financed through the operating capital of that firm that you've purchased, especially in the scenario where there's a retiring, seller who wants to take a step back in how much they're working. It's very typical, but remain involved in a limited capacity. And that free cash flow that's now not paying the salary of the seller can go into financing their exit as they vest out that 67% delta, which happens usually over 2 to 5 years following the initial closing payment. Um, so the most important thing is getting the upfront cash. But there are some implications into, if there's not enough cash left over because let's say the owner isn't able to take a tremendous step back in how much they're working, they have to keep working, they don't want to be paid less on a salary. You do need to think about the cash of the entire exit. It is going to be over several years though, so you have that working for you in the accounting firm M&A space. So cash is the first thing. Second thing is line of credit or a small business loan, right? The third thing is if you have cash and you want to buy securities, you can use those securities to put up against the line of credit. This is a strategy that we've seen a couple of times, which is very interesting. So not only are you investing the money, right, because you're buying securities, but you're also securing the line of credit that you're using to pay the down payment on a practice. And I have a great referral here for a financial advisor who can help you execute this vehicle if you're interested. This would be a great way if you wanted to do more, kill two birds with one stone. And I'm happy to talk more about that if it's interesting. Um, the last way I want to talk about just at high level is working with an external investor. I spoke this morning, and he might be listening to this, to a gentleman who runs about $1 million revenue asset management company working with an independent broker dealer. He manages, it's probably in the neighborhood of 100 million in AUM, and his revenue is about $1 million a year. He's interested in buying an accounting firm. And some of the firms that I might show him based on what his particular strategy um, are firms that are larger than him. I have a firm in mind for him that's about $1.6 million in top line revenue. So it's $1 million financial services company thinking about buying a $1.6 million accounting firm. Um, First of all, it's possible to do that. It doesn't need to be a merger. It can be an acquisition. But chances are that accounting from the 1.6 million is going to go for 1.5 times gross revenue. It's a $2.4 million valuation. Even 33% down of that, which is $800,000. I doubt that this guy has 800 grand, in cash stashed under his bed. So, one option is he could take a loan. Another option is he could, scramble together friends and family financing. Another option is he could work with an external investor. Um, External investors are very interesting because there is strategic possibility as well as you gaining the cash, right? So, a couple examples. We work with a lot of Indian outsourced firms. Um, Actually, we don't work with a lot of them. We work with two. We've interviewed about 30 as a firm. We work with two firms that we think are very, very good. Um, the good firms that we work with have access to investor dollars over in India. And what's interesting about that is that if you get involved with an Indian investor, chances are there's going to be a component of that investment which involves you gaining the infrastructure over there secured by the Indians' investment capital to be able to do outsourced labor over in India. Say lower value 1040s, right? The 700, the $800 1040s on the tax side, the ones that you're not devastated as a business owner if you lose from a value perspective, as long as everything is in a secure environment, clients aren't having their information stolen. And again, this is being secured in theory, right, by an Indian investor. So all the diligence that's done is going to be done by the person who's financing the operation. I think that's important. As well as bookkeeping, controller services, accounting services, a lot of the functions that are very expensive here in the US and that there's also not a lot of talent for in the US. These functions exist in India, and if you find a good firm, which you certainly can through us, not only are you getting a cheaper solution, you're actually getting a better solution, I hate to say it, than a lot of the talent that's available here in the United States. We could talk for a long time, and it's not the topic of today's webinar, but there is a talent calamity in accounting in the United States today. Not enough people in the profession. The people who are in the profession are largely incompetent, plain and simple. However, there is more opportunity because of this in the accounting sector than ever before. So Indian investment in the Indian ecosystem of the commoditizable parts of the practice, it's a very interesting premise for someone who is seeking to help capitalize a roll-up operation and is interested in that labor force over there. A secured labor force is a component of the transaction. It's a very interesting strategy. Another option is, let's say you're an accounting firm, right? You're in that second category and you want to buy another accounting firm, but you don't have the cash to put up for closing. You might work with a US investor, say a financial services company. Financial services company might be able to front half of the cash, and let's say you can front half of the cash, and you can use the investment opportunity as a way of entering into a joint partnership where now, instead of just having tax and accounting services in the combined entity with the buyer and seller, you've just gained this mutual partner in a financial services companies. Now you have the ability to manage assets as well. So the way I want you to think about this is any kind of decision that you make, and this was my earlier point about if you have cash laying around, you want to use that cash to buy securities, use the securities to secure a line of credit, use the line of credit to pay the down payment on the practice, and even have now operating credit to use for the combined entity over a period of years. The strategies that I like to recommend when it comes to financing are strategies where the whole should be greater than the sum of its parts. That's really what you want to think about. How can I use this need that I have to provide capital as an opportunity to gain more partnerships, more connections with great people that is going to align with a 10x kind of trajectory when it comes to scale. 10x rather than 2x is what I like to think about. So guys, thank you very much for attending today. We're going to do these webinars for 30 minutes every Friday. So look out in our newsletter, on our website, on our LinkedIn for additional topics. If you have requests or suggestions for topics, please submit them to me. Jeff Bruskin, thank you very much for attending today. Have a great weekend, everybody. Bye-bye.